The dollar is off to its worst start in nearly half a century. Why are we seeing a weakening dollar, and what does it mean for the economy? We asked Jose Jurado Vadillo. He's from the Seaman Research Institute, ASU's W.P. Carey School of Business. Good to have you here. Thanks for joining us. We appreciate it.
Absolutely. My pleasure.
Okay, so dollar's off to the worst start in like 50 years, whatever the case may be. 3-year low even. What is going on here with the dollar?
So I think there's a couple of factors at play. On the one hand, you have policy uncertainty, especially regarding trade. You have tariffs all over the place, and that puts a lot of uncertainty in the business sphere. Secondly, you have a slowing economy, which ties to the first factor. We're currently expecting 1.6% GDP growth this year. 1.4% this year and possibly 1.6% next year. So well off our 2% trajectory of growth. But I think the more important factor is the fiscal. So even before this bill was signed, the Congressional Budget Office was forecasting that by 2054, the debt to GDP ratio of the U.S. would reach 160%, clearly an unsustainable level. And this bill obviously added $3.3 trillion to our debt.
Indeed. And it sounds like global investors, especially with these GDP numbers, global investors, they're not as enamored with the U.S. economy as they used to be. Is that what's hitting the dollar here?
Partly. So the status of the dollar as a reserve currency is not currently at risk. However, international investors are certainly hedging their exposure to the U.S. dollars through financial instruments or through less holding of equity or other forms of debt.
Are they rotating out of the U.S. into Europe and other areas?
I'm sure some of them are. Sure.
Yeah, and is that something we're likely to see more of, especially with the uncertainty, as you mentioned, with tariffs and global trade?
Yes, so I would expect institutional investors and other large investors to hedge their exposure to the U.S. to some extent. I don't foresee them necessarily dumping U.S. securities at a large scale, but it only requires them to stop buying our treasury bills for the yields to rise.
You're right. Okay, correct me if I'm wrong here, but a lower dollar means less purchasing power. Wouldn't that equate to more inflation?
Correct. So there's been some estimates put up by people. The current range is that 10% depreciation of the dollar will lead to around 0.3 to 0.5% increase in inflation.
Okay, but that's we're fighting inflation right now. We're doing our best to fight inflation. And what does that mean as far as what the Fed's going to do regarding, the interest rates?
So the market was previously pricing the likelihood of 1 or 2 rate cuts later this year. However, the Fed has made clear that they're waiting and they're going to wait and see what the inflationary consequences of the tariffs are going to be. So my guess is that the flight away from the U.S. dollar is going to decrease the range of options of the Fed and will make it less likely for them to cut rates.
I was going to say rate cuts. I would think a weaker dollar and rate cuts kind of go hand in hand. You don't want that. So that's not going to make the president very happy, is it? He wants to see those cuts, but the weakening dollar is not helping matters any.
That's correct. The president does want to see cuts. Part of the reason is higher yields obviously increase the cost of servicing our national debt. However, one thing that we should keep in mind is that the Federal Reserve has certain ability to influence short-term rates, but long-term rates are much harder to influence through monetary policy.
Interesting. Okay, everything we're talking about, could all of this change in the second quarter? Could all of this concern over a weakening dollar just be completely overblown with the next set of numbers coming in?
There's certainly room for market movement in either direction. However, I think some of the fundamentals that we're seeing in terms of the size of the debt and the fiscal trajectory going forward are going to be much harder to move away from.
So in terms of financial interests, U.S. exceptionalism, it's always been there. The dollar's always been there. It's the basis of everything. That is still relatively strong?
Yes, that's correct. There's a long-term movement by certain countries to diversify away from the dollar, such as China, that is conducting a lot more of their transactions in their own currency as opposed to the dollar. But the status of the dollar as a reserve currency remains strong.
Yeah, there's nowhere else to go, in other words, right?
That's correct.
Yeah. All right. Jose Gerardo Vadillo, good information and good to have you here. Thank you.
Thank you.